Okay, welcome everyone. I really appreciate you listening to us. Unfortunately, Andrew is sick. I think there is a cold going around in London, but he will come for the next episode. Now, before we actually start the topic of this episode, don't forget to subscribe and like here on YouTube or on Spotify. Please make sure, because you putting a like actually or following us really help us to get the best content ever with good guests like Uday Goel. Uday, thank you for coming and participating. I know this sometimes can be uncomfortable being on stage and answer questions that you might not be ready for.
Thanks, Tiago. Thanks for having me here. It's a
So
pleasure to be here.
thank you. So Uday, can you tell more about yourself as well as Merqueb, and I'll explain why I really wanted to have this episode with you.
Perfect. Yeah, I mean, sure. So I'll start with Merqueb. So we are an index provider firm. So we started back in 2019. So it was started by a bunch of our co-founders who came from S&P, and then we also had our CTO who came from the Silicon Valley. And the idea was to create a company that would use the latest cutting-edge technology, the right kind of data to come up with new indices, more innovation, and be able to promote innovation. And on that front, so that's how the Merqueb started, and that's the journey we have been on. We created a really good platform, completely cloud-based, and now we are actually progressing more into the IP-driven business where we're looking to do more as out there. Now, on my side, I actually was introduced to the financial services back in 2006, really back in the day. So where I joined Lehman Brothers at the time. So I started on the equity exotics trading desk based out of India at the time. And then in a year's time, I jumped to RBS in London. So at that time, my seniors actually had this vision that they thought some new kind of indices are coming out in the market. And they said, let's start a new business called Dynamic Strategies. That's really what I got to be part of. Over a period of time, we called it different names. We called custom index trading, but essentially that's the area where the industry now knows as QIS. So I stayed there at RBS for like 14 odd years, and then I decided to join Merqueb, which was actually recommended to me by quite a few of my friends and colleagues, and I was like quite excited. I was like, right, so your clients are recommending you, must be doing something good.
Yeah.
So yeah, so I came here. So Merqueb, I actually lead the research and origination, where my primary role is about researching new products and new indices, working on new solutions with our clients.
I think it's interesting, right? Because that's exactly why I wanted to have you here, because I think there is a lot of, I mean, QIS, let's say investment solutions or dynamic solutions, as you pointed out. As an hour long story, right? Not from the 90s, of course, with the research, but of course the democratization of indices, exploded back in 2000s and then 2010s. It's been going through a cycle. So how do you split, let's say, the beginning of the QIS with, of course, the JP Morgan momentums and other indices, the explosion on the insurance and then institutional, and going from what used to be just a factor-based, right? Factor-based to what we have, which is, it's a completely explosion, right?
Yeah, I mean, it's a good question. I mean, so QIS has been through a lot of evolutions actually. So, and I was quite lucky to be part of that. So I'll start before the period before the GFC. So before the 2008 period came in, and before that, this was a very much of a niche area where the banks were dominating the space. They owned some of these indices. The ideas were still very simple, and some of those ideas we can actually call something like a smart beta today as well. But that was an area where the banks were trying to put new concepts in the market and testing the market. So like green indices and those things started at the time itself. Now came the financial crisis, and you see the investors becoming a bit more risk averse, and they now want to have, say, a bit more diversification. They want to have, let's say, fixed income underlyings along with equities. They want to have some commodity exposures. And in fact, there was an incident that happened. I mean, I was at a conference, I think it was back in 2010, I guess. And one of the things that the panel was really talking about was that, hey, we have had 10 years where the large caps, market weighted indices have not really done much. We've got the dot-com bubble, we have the GFC, there is not doing much. But what we see is that the low vol indices and the equal weight indices have done quite well. So maybe this is what we should go for. And that was the kind of innovation concept that was starting. So that's the time where we had a lot of diversification indices, multi-asset indices that came in. We had index providers who started participating in this space, and we have some more indices. Like this started to become more mainstream. People started to recognize it. And the idea was to provide different investment concepts, some things that were not accessible to the people previously. Now, we entered the May 2015 odd period where the interest rates were really low.
Yeah.
And that is really the time I think I would say QIS really did well.
Exploded.
And really became more mainstream because, if you had something which is on a benchmark index, a product on a benchmark index, you just no longer could offer reasonable terms. And so people turn to QIS to say, look, how can I create an index idea which is innovative, which works for my clients, and I can actually create a product out of it. And so that's where like a risk control and other indices came in, and it became a very popular space. And even the US insurance space, that's really around the time when this whole space exploded.
Yeah, with the risk control indices, right? Low volatility, which allows to cheapen the options and offer some good exposure to the equity markets, right? While offering capital protection.
Because the whole logic was that you can be exposed to a benchmark, and that benchmark could go up, say, 5%. But let's say if its performance is capped at, say, 1%, you're only getting 1%. So can I have something alternative? So that was the evolution of QIS. And then we came to this COVID period and the 2022 period where we had high inflation as well. And so this is where we see QIS having evolved, where interest rates are higher now. People want more income. People want indices to have a higher vol. So QIS is now evolving. There are a lot more factor indices. So it's a huge space now.
It's crazy, right? Just to give you an idea, is just for example, we add around, because we cover all the structured products that are issued across Europe, North America, LATAM, and APAC, and we have around between 12 to 20 new indices every day, which is crazy, right? It's massive, right? Of course, the market share with compare with single stocks, the main indices, it's not the same size, but the evolution and the bespoke indices that are out there, it's exploding. And that comes the other side, right? From the part of the audience, which is mostly advisors, is what's their value? Why do they should go to an QIS index versus just being long the S&P 500, just going and be on an ETF with low cost, right? Because let's face it, doing an index has more costs because there's more things involved. So for you, what's the value? What the advisors should look at it in terms of actually providing the best value to their clients?
Yeah, I mean that's a good point. If you think from an advisor point of view, what they are looking is to have access to products that would meet their clients' requirements. Yes, having access to a low-cost ETF is a good option, and they should probably have that in the portfolio. But then there are other requirements from the clients. For example, a client may want an insurance product, and in there they want to actually have some kind of a flow, like the USFIA offerings. Maybe the clients want to have an income product. So there are a lot of requirements that the end client may have, and so it's not so for the advisor. It's not always about, hey, can I get the cheapest capital growth instrument? They may actually want to go for other instruments as well that actually fit what the client's requirements are. And that's where QIS really comes in, because it can create those customized indices which can allow the creation of those products and those kind of terms that the advisor would like to buy.
Okay. You're getting me very excited. This is a very good topic, as we talked in the past. Is for me, it's two things, right? When I look at these indices, and probably, unfortunately, I do spend too much time looking at this. It's two things. One is the exposure that you get, and then second is the overlay that it allows you when applying structured products. So on themes, on the exposure that you get, what are you seeing? What are different exposures that you see in the market? Like, you're doing this research, what type of exposure are people now using, right? It doesn't seem to be value because value is not performing that well.
A lot of the what we see more recently over the last couple of years is income. Interest rates are high, and people are now thinking, right, if I actually now value income, something that was missing over the previous decade, but that's actually available now. So you see a lot more income-based products that are coming up. There have been, for example, the auto call ETF, right? That came up last year, which is all about income. So there is a lot of like a day to day, we talk to the clients and they keep talking about, hey, can we actually get some income product based on certain idea? Or certain base. So that I think I would say is definitely one of the key things that has really come up a lot more in the last few years.
Mm-hmm.
I mean, beyond that, I think there's another concept that comes up is that, the 60/40 rule that industry has followed for a long time for diversification, that rule broke down in 2022. So advisors really have the question that, look, their end client doesn't really care whether it was 60/40 or it was some other mix. Essentially, it went down. So what can they really offer as a mix to the
Yeah.
60/40, not to substitute it, but to mix with it, so that they can still get some kind of returns during those years, so that as a portfolio as a whole can still continue to grow. So
Yeah.
that is another interesting topic we come across. And finally, I would say there's definitely a lot of discussion around education, training, transparency, that we talk to. And as you talked about, the democratization, right? So advisors now want to be involved in creation of the indices. They want to have access to the tools, the underlying data, and they want to suit it to the requirements of the clients. So we see all these trends that are happening now, and over the last 2 years, we've seen a lot of demand, and on a daily basis, we see a lot of activity with the clients on these fronts.
Okay. You're completely right. Like the income QIS, it's what it's been exploding, right? And you have two main types, right? Two main features that are doing. One is the target volatility, right? And I mean, and you guys have been very successful in the US and now expanding into, of course, in Europe, but also in Asia, more on the institutional side. So target vol, can you explain? Can you explain how they work? And then second, how do they compare with other, let's say, risk control indices, or the let's say the old products from the tens, right, 2010s, which were very popular because they're very different.
Sure. I mean, so target wall. So I mean, we talked about target wall and risk control. So I'll probably combine them into a single term to start with to explain the mechanics, and I'll call it volatility control. The underlying logic here is that you have got a risky asset, let's say one of the benchmark indices, for example, and now you say, I want exposure to it, but I'm really concerned about the risk I take. So I want to invest based on my risk. Risk is my driver. So let's say if the risk is going higher, I want to reduce exposure to risky so that I still have the same kind of risk. Or if the risk on the risky is going low, I want to add more exposure so that I still actually have the similar risk profile. And that's what volatility control does, where the risk really is measured as volatility. So you can observe it daily, weekly. Now we do it intraday as well. You can have leverages going from 0 to say 150 to 100%, depending on what kind of market it is. And so that's what vol control is. Now, within that, we talk about the risk control, which is the old way, which was, when we say the old way, which is the way which was designed for 2010s,
Yes.
for the low vol decade, because first the interest rates were low, and second the clients had become a lot more risk averse, and so you
Yeah.
had the situation where risk control basically were the indices that had a lower vol, so clients were targeting a lower risk. Plus, the idea was to actually have volatility below a threshold. Whereas now what we see is a target wall area where people, which is a very similar mechanic, but a very subtle difference. That
Yeah.
now the clients are actually saying, I want the risk to be much closer to where the natural wall of my risk outlier is. And I want to have my risk around this, not capped, but around
Yeah.
this. So
Yeah.
if you think of a band, if you have your target volatility level, the threshold, there is a tight band in which I want my risk to remain. And that is a quite an interesting feature that you have with target volatility indices, because once you get this band,
Yeah.
now it makes it easier for a client point of view. It makes it easier to understand what the risk adjusted returns are going to be, because the risk is a lot more stabilized. It also allows dealers to create products on certain baskets that don't have a listed options market. So now they can actually hedge it, they can manage it on their books. This is where the target wall really comes in, and we see a lot of indices that have been launched with this, because it helps product creation. It helps meet some client requirements. If a client says, I want to keep my risk at 18%, fair enough. That's where your index is. If someone says my risk is around 15%, yeah, well, that's where the thresholds could be. So it also allows that kind of customizations to the clients.
But I think it's important to highlight, right? Because as you said, like the target volatility will be your risk, will be, you're adding or subtracting versus the markets. If you have a target volatility above, let's say the equity market, which currently has, and it's now low, right? It's at 13, 14, but usually let's say 18%. Just if you have a vol of 40%, you're kind of doubling that potential risk on the downside as well as on the upside. Right? Risk goes to both sides.
Well, actually, and that's one of the things that I also want to clarify for the audience is that a lot of times we think about target wall and we think that, hey, the wall only goes up on the downside. You're actually quite right. In a V-shaped recovery, wall also goes up on the upside.
Yeah.
And so this works on both sides. The key thing is, think of it like you're on a cruise control in a car. And you are around at a certain level. You're not looking to speed up when, let's say, the road is empty. You're actually trying to be at that speed, regardless whether the speed can go higher or not. And that's what target wall is trying to do, give you that stability.
That's a very good analogy. I liked it today. But let's talk about the risk control, or the ones with that very low volatility, right? Because they used to be very popular. And unfortunately, since COVID, they kind of failed. And the reason why they underperform is a simple reason, right? Because the volatility, the long-term volatility, or the volatility, how you react to change, right? You have much more short-term volatility, right? And long-term volatility low. And I think it's interesting that it did work. So it did underinvest when volatility went up. But the problem is, because the market recovered faster, you couldn't participate on the recovery. And I think, especially in the US market, they were kind of, bad taste on these products because of it. But of course, that's part of how they were built. Was a completely different macro environment. Can you call this macro environment? Not really, right?
Right,
More.
because they translate into a massive liquidity boost to the economy. You had very low interest
Yeah,
rates, and then
correct.
the interest rates suddenly went up in 2022. So you had all of this happening. So I mean, it's a very good point you touch on, because a lot of times when we think about risk control, I think people tend to associate that with performance, because that's the link you have actually put together here. You had risk control, but they did not perform. Now, the objective of the risk control is to control your risk, the volatility. And in certain vol regimes, it works a lot better. For example, low vol regime, it works really well,
Yeah, yeah.
because the vol is low, and if it gets too low, you can leverage up. And this is a period when equities tend to be going up, or the risk asset tends to be generally going up, and so you can actually participate more in the upside. Whereas you can have periods where, let's say, the vol gets choppy and the market's on a downturn, and these will protect you in the sense that they will give you a
Yeah,
lower drawdown, which is always better, because it actually, if you have a lower drawdown, it gives you a better chance to go back up.
yeah,
Think of it this way: if you have a small dip, or you actually fall down a cliff, where
yeah,
you want to be, right? So it actually gives you a chance to recover faster.
yeah.
But in the recovery, which we have seen, I think, in the last 4 or 5 years, where the recovery can happen very quickly,
Right.
that's where you are going to go up slowly as well. That is something that will happen. Now, for some clients, actually, it's better still, because in all, if you look at this way, if you have been invested through the whole period, then you had a lower downturn, but a lower increase as well. Overall, you are probably, in a lot of cases, at the same level as the initial risky asset, but you did
Yeah,
not have to go through the stress of seeing your portfolio do a whole V shape.
yeah,
On the other side, if you have products which are more path dependent, they also benefit, because let's say you may have, say, a barrier option kind of thing, like, say, an auto-callable stuff, right? So
yeah,
if you have a barrier, then if you have a big dip, you can hit those barriers. Whereas with the risk controls, chances of hitting those barriers reduce, because there's a mechanism built in to take away your leverage, your exposures, when the underlying is going down.
yeah.
So in that sense, it still helps, but yes, it is not engineered to always outperform the market. It is not going to be your always winner kind of candidate. It's going
Yeah.
to help you manage your risk.
Now, on that topic, right? You're completely right. It has their features. It works on a different environment, and as you said, like, it does what it says, which is something that I really appreciate on indices because they are clean, they are transparent, the maximum that they can. But there is a new feature that, because of technology, is helping, which is the intraday risk control indices, because I find them theoretically very, very interesting, right? Because it means that you can, again, you will have extra costs, right? Because you're in and out, but you can exit and you can in much quicker, right? Than on the typical, weekly or monthly recaps, or changing your exposure. How do you see these intraday target vol indices working? What do you think it's the main advantages, and of course, like, the risks that it comes with them, of course.
Yeah, I mean, so intraday, I would say, is an evolution on what we already had before. So, I mean, the whole wall control indices, call it risk control, target wall, have been in the structured product space for more than 10 years. Actually, a lot more than 10 years. We are close to 20 years now. And people learn from experience. And one of the challenges, I mean, I can tell you from my experience back when I was on the trading desk, was that in the morning you come in, you see there's a bad news come in, market's going down, and then the only time you're going to measure your risk is at the close of the
Exactly.
day, and then you're going to get exposure out at the end of next day. So you literally are just waiting for 2 days, waiting for this thing to readjust. And you would have sometimes clients calling you and say, "Oh, I see the market going down. When are we going to exit?" And I'm like, "Well, wait for
You need
next
to
day."
wait.
And that was, I would say, a very much a technology limitation on how you could actually do this a lot earlier. And that's where I think intraday comes to play, where it actually allows you to measure your risk during the day. It allows you to sort of exit during the day as well. And in that sense, it actually, to your point around the whole thing about the V shape and stuff like that, it allows you to also time getting in and getting out a lot more quickly. So it has definitely those benefits. Another benefit you can actually see is with the close of the day, one of the challenge was that all the execution orders had to go at one point in time. All these risks measures were based on one value. And we know one thing in finance, there's noise in these values. So if you're going to measure your risk based on just one value a day, you actually are bound to get a much more noisy indicator, which is where the whole smoothing would come in, but it's still a noise indicator. And if all the orders have to go at the same time at the close, the dealers have to really plan accordingly. And it comes to the liquidity question as well.
Yeah.
How much product you can write on that index if you can only execute so much.
Right.
So with the intraday, you actually tend to solve that problem, because in case of intraday, you would say, I would measure my risk over, let's say, a 10-minute period. I will take the data of a 10-minute period, it's my window, and I will observe the price in this time. The concept of this window means that you're able to sort of remove some of the noise, because you are now averaging the prices, like TVAP methodologies you'll use, and it gives you much more stable risk band measures. On the dealer side of thing, because now they also get to execute over a window, they actually have got a much more time to put those orders in. And they
No.
don't need to lump a huge order and put it at the close, because the intraday will gradually take your the leverage down. So you actually break your orders into multiple chunks and still actually execute them over a wide window. So from a more hedgeability point of view and investor point of view, it actually seems to work better. So we see these benefits coming up, and you're right, there could be more turnover, but from the indices that we have worked on, we have seen that generally the returns, the benefits, they outweigh this turnover
The
cost.
costs. And you think the cost is the biggest, let's say, side compared with other risk control indices, or is there something else I'm not seeing?
So I mean, your cost, I actually refer to the turnover cost here.
Yeah.
So
No, yeah.
the amount of execution cost you're actually putting in, there's also a cost around the operational side,
Mm-hmm.
because now you're not measuring it once a day, you actually have to observe it multiple times a day. So there's an operational cost there on our side, because we are calculating and maintaining these indices. We have to make sure the data is accurate much more frequently, and the data has to be disseminated on time to the dealer so they can execute them as well. So there's a bit more operational risk as well, which adds some costs as well. So there are some additional costs on that front. But the benefit that we find is that if the returns are better and the indices are now able to react a lot more faster, that actually helps. Another benefit we find is that, when we talked about target wall, we said there's a threshold and then the wall is around a band. If you are able to execute a lot more quicker, you are able to reduce the size of the band, which also means you are able to now getting exposed to a much
Close.
exposing to a which is closer to what we intended. And for the dealers, it also means that they are able to also price these options slightly more better because they have much more certainty where that band is.
Okay.
And it also helps in product creation. But having said that, look, I mean, there are a lot of positives around the intraday. There are also negatives because there's a big now data side. So you can't just roll it out on just any underlier. You need to do it for underliers that have liquidity throughout the day,
Yeah.
cheap enough to execute. And you also, because it gets operationally intensive, you also need to engineer them for products that are being traded for decent size.
Yeah.
You can't have small clips, small ticket sizes for these indices because the operational costs will be just way too high
Yeah.
to satisfy these indices to support them.
So thank you, thank you. There is one topic that I want to talk about with you, right? And again, I've been discussing this and talking about it for years now, me and other people in the market, and and again, I like the product. I like it, for me, it's a feature, but of course, there comes with risk or tail risk with it, which is of course the decrement indices. Now it's booming. I mean, it's not still a niche in markets like in the US or in Asia, but in markets, especially in France, Canada, Italy, Germany, it's growing the decrement indices. So, what are for you as a researcher, right? And by the way, I think we looked at this data. Was it last month? Where we were actually highlighted to you that you're now doing 1/3 of all the new decrement indices in France. Is what are the biggest misconceptions around decrement indices?
Right. So before we go that, let me just clarify what decrement indices are. So you take an index, let's call it your underlying index, and then you deduct a fixed number from it. You create out daily. So the question is, what is this fixed number? Why is this fixed number there? And that understanding is much more important. And a lot of misconceptions really come out of that. So the general idea of this fixed number comes from the fact that these decrement indices are going to be used in structured products, and they could be used for the underliers could be, say, single stocks or a basket of stocks. And so these are baskets where the dealers may not really have really liquid options market, or maybe limited liquidity around, say, the dividends.
Yeah.
And it's been so many times. I mean, we've read in the media so many times over the last decade or so that the moment there's a crash, all the dealers are looking to sell their dividend exposures. The entire market is one way, and it upsets the market. And then for a year, everyone's recovering from that. So what decrements really tend to do is they are taking that variability, that exposure around the dividends, and condensing it to a constant number. That is the primary idea why you have this decrement as a fixed number being taken out, because your underlying is total return. So the dividends get reinvested here. And so any variability will get reinvested, and a fixed number is going to come out. Now, so that's a construct. So mathematically, it's a very simple construct. And the question really comes out is, how do we disclose these to the clients? How do we control what exactly this number is? So one of the things that we get asked sometimes is that, why do you have this number? Is there a fee? And sometimes you even get the other hidden fees. And so I think so that is a good point, because it's very good to ask that question, because as an investor, you need to know what that number represents. And what the way we see here at Merqueb is that when we started, we were quite conscious that, look, this is a number that literally could be optimized for something. And so we had a very strong rule, a very strong policy that we put in place to say, we gave a good guidance on where this number can be.
Yeah.
It needs to be determined by the past dividends and the expectation of future dividends. It needs to be reasonable. We should be able to evidence that. And for example, if a stock has not given any dividend out for quite a few years, the decrement is zero.
Yeah.
So other example could be where if a stock has, let's say in the last year or two, has given a special dividend, say 12% or 15%, then your decrement cannot be 12-15%, because, hey, that is a one-off special dividend. So we actually put a lot of these rules into our system, and we made sure the people were trained up. And this is something which is non-negotiable on our side, is that if we have defined that this is where the decrement levels can go, that's where they will be. I mean, we will not go above that. And so that's something we tend to do, and that's something we put into our documentations. We make sure we explain this properly to our clients. So there's full disclosure, there's full transparency on that front. And we also expect the product issuers and the distributors to really question those numbers. Just to make sure. I mean, we know that. I mean, banks are very, very particular about this. I mean, they'll have their compliance looking at this as well.
Yeah, completely.
So I think that's how we try to deal with that kind of if we say misconception, it's also a misinterpretation really of what that number is. But I think in the markets that you talked about, for example, say France and Canada, I think that's where people have become a lot more comfortable with this construct.
Yeah.
And it also becomes a product enabler, right? So if you want to do a thematic index, so like for example, if you had this European defense thematic index that was very popular last year, right? Now, if you want to open a structured product on that, you have a basket of stocks where the dividend uncertainty is there. The combination, the basket itself is uncertain. You don't know what stocks will be there tomorrow. So how does someone really price those exposures?
Yeah.
So this actually becomes a product enabler as well, and to some extent, where clients are getting exposure to structured products on baskets that they would otherwise not have exposure to. So decrements have a usefulness as long as we do it in a controlled and proper manner.
Yeah. So I think we need to talk about the future, right? Because that's your job. It's research. It's trying to find the value. If you have a crystal ball, or without giving us your secrets, what do you think is going to be the next thing on indices and QIS linked to structured products?
So I have actually seen this space evolve so much over the last decade or so. And one of the things the way I understand is that a lot of the changes, evolution are driven from external factors. So, some macro event has happened or regulatory changes have come across, which is where we saw the low interest rates came in. And maybe then the COVID happened, the high inflation environment happened. We think that the next evolution is going to be more around technology and AI. And that is going to drive what kind of indices we tend to do going forward. There could be more democratization. There could be, they say, maybe even changes to how we actually do current business. So I'll give you a good example here is, so like we work with a lot of data providers, alternate data providers, you can call them. But essentially, there are a lot of people who are small shops, but they've got really good data. They've got really good tools. And given our size, we actually love to collaborate with these people. And we say, right, let's bring you in, let's get your data in, and let's try to build some indices on top of that. And some of the ideas these guys have is a bit revolutionary, really. I mean, on how you actually want to see the markets, see the ecosystems, even like, for example, sector classifications. How do you want to see them? So we like to bring these in there, and that is the entirely technology and sometimes AI play. And that actually is, I think, will drive how the indices will evolve from this point onwards. We also find that, as I said before, the advisors are looking to get more hands-on. I mean, there's a democratization you talked about, right? So people want access to tools. This is a digital world. Everyone wants to be very much more integrated. People want access to tools that they can play around with, and they can see the numbers, they can see the backtest results, they can analyze them, test them out, and once they're happy, they want a quick on the process as well. So that's where we develop the platforms like the Garage platform that we have actually been talking a lot to our clients about since the last year, and has been quite instrumental for the decrements I talked about, right? So that's the area where we see this whole evolving into. Now, obviously, it will drive changes. For example, target wall became intraday target wall. So all of these will drive those changes. But that's how we envision how this space is going to evolve from here.
Okay, Uday, one last question, which is kind of an advice for investors / advisors. When can they understand if the strategy is robust or over-engineered?
That is extremely good question, and I think extremely important question. I think I would say it's not just for the advisors and the investors, it's also for the practitioners, really. How do you know if something is robust or something has been over-engineered? I like to start with saying that you need to think about the what, why, and how of an index. So what is the index supposed to do? Let's be clear about the objective. So that's quite important. Then why is the index achieving this objective using this mechanics? Why have we chosen this? And there has to be a clear articulation of that thought. The how really is more like, peeling the layers of an onion. It can be quite painful with tears and stuff. So you want to go down into certain degrees, don't want to go down to the actual mathematics, but how you're going to do this thing, a bit more detail about the mechanics. So that is something that I think everyone needs to know that this is the suitable product, and when it can work and when it can fail. There are a few more things that you can actually do. I mean, so for example, you can see how these indices have worked in different market environments. So for example, if someone is given you an index with a back that goes like 45-degree line kind of thing, something's wrong. I mean, I haven't seen a strategy that works in all environments.
Well, in back testings, it always works, doesn't it?
So that's one of the areas where you need to look up and say, look, is it over optimized? Because how come it actually works in every single market environment?
Yeah.
That's probably like the holy grail of the indices. So if a chart actually goes up straight up 45-degree, it should be questioned actually. Why is it happening? I would say it's a red flag in some cases. Another thing actually which I tend to like to do is have a look at the parameters that people have put there, right? So with complex indices, you get so many parameters, and sometimes those numbers could be like, say, 5 or 6 decimal places kind of thing. So you need to actually ask, look, hey, is your strategy robust, right? I mean, why have you got so precise numbers? Let's have some values which are easy to talk about. So let's have, say, 20 days. Why
Yeah.
do you want 23 days? And those kind of things. So I think that also helps figure out exactly whether this has been over engineered. Have you just done a massive solver and then picked the best number out of everything and gone with it? So that's what I like to look at. But what I've seen generally people tend to do is they look at the returns, they look at the risk, they look at the Sharpe and say, oh, this thing works. And that actually is looking at the statistics is important,
Yeah,
but
yeah,
it
but it's only.
doesn't really do that level of diligence. So I think it's quite important that we do this kind of diligence, and we shouldn't be scared to ask for more data if we
Yeah,
need to. And I think that's quite important now. The data is a lot more easily accessible, and that's
yeah, yeah.
technology coming into play again.
True, true. Okay. Thank you, Dai, for participating. Hope you enjoyed. I really appreciate your input. And yeah, hope to see you again.
Thanks for having me. I appreciate you calling me here.